Hello, everyone. Jesse Webb, Traders Pro. Market conditions still wavering, pulling back into these support areas as we've been talking about for the last few weeks. And I will just reiterate that we are at the upper range of this trend significantly in terms of this indicator, which gets typically it extends up to this 8 to 10 range. We're now at this 13 range, so we've overshot the upside just like we overshot the downside right here. So this is definitely a location that we want to be paying attention to on some of these shorter term indicators as things are starting to pull back. We've got a little bit deeper retracement on momentum and breadth. Sentiment is still quite positive, which I would expect, as we haven't really seen any type of panic as of yet in terms of a few days down. Interesting news item this morning where we had Fitch talking about the possibility of some downgrades on the banks. That's pushed futures down significantly. S&P futures down 30 or so points. So we'll see if what kind of volatility, if any gap activity, if we sell off in the morning with this gap and then rally back higher. We'll see if we're starting to shift over from buy the dips to sell the rips, which is any rallies that are moving higher get sold into. We haven't quite shifted there yet, and if we get a news item that is a little bit more systemic, like something regarding banks, then that definitely is going to spook the market into submission, and we'll see if we get some retracement. So as we've been talking over the last few weeks, sometimes these updates, when we're talking about what the market is doing every single day, it gets kind of mundane. But that's kind of the point of how tops and bottoms and trends ultimately happen, is they're day by day by day. So they all of a sudden are not just, oh, this is the exact day of the top, or oh, this is the exact bottom. They unfold in a slower process. So that's the process that we're experiencing right now. Is, are we in this upper range or are we in this lower range of trend activity? Buy-sell ratio continues to be the bearish side of things. The bears are in control. With this quick glance here, the buy-sell ratio, we can see that we've got just more stocks in the database that are bearish than bullish. So we've got currently this ratio is 0.49. So that's definitely accelerating, and we're seeing just this real solid slide higher. It's happening kind of slowly, but interesting markets to be paying attention to right here. We're also showing some weakness in this overall the overall market ETF. If you scan to or scroll to the index page, market ETFs, and then, or excuse me, that was not the one I wanted to go to. I wanted to go to the sector ETFs, and then sort by signal. You can see that we've just got three stuck right here: energy, healthcare, telecommunications, and the rest stuck in hold. And then we're seeing consumer service, real estate, tech, and utilities, and global consumer starting to the downside. So some of these hold ratings and sell ratings are building momentum as well. If we take a look at SPY and see where we're sitting here, we're also now approaching the edge of that, turning into a downtrend. We had a decent rally yesterday. We'll see if we continue to hold any kind of support right here. If not, then we're probably going to continue down to this next step, which is going to be that 429 range on SPY. So definitely nothing to be overly bullish about and excited about. In fact, seeing a lot of different discussions about economic conditions. One of the main things that I like to focus on in terms of the large economic condition, and that's why I have it on the site here, is the bond yield curve, because it is the bond market essentially controls the stock market, and the bond market controls the Fed. And so ultimately what the bond market does is where equities are going to go and where the economy is going to go. So the biggest issue that we have right here, but this is not correlated, day by day and week by week. This is a very, very slow moving process, because we'll have traditionally inverted yield curves are 15 to 18 months before you start to see any kind of slowdown or a recession in the economy. So let's just take a quick look here and see this inverted yield curve. So essentially the idea behind yield is that the shorter end of this yield curve, which is this 3-month, 6-month, 1-year time frame, is paying 5% on your money. So essentially a bank account, a savings account, is paying you these rates for just sitting your money there. but it's paying you less money to lock that in for 10 years, and it's paying you almost less to lock it in for 30 years. So what do you think investors are going to do? Are they going to go out and buy long-term debt? And are they going to borrow money or put money to use in the short term here? The theory is no. The theory is that the Fed wants to slow down the economy and slow in order to control inflation and control asset inflation. So they're going to make it harder to borrow money, which is going to spur these big moves higher. Okay, when you have a lot of money in the system, especially cheap money, that's easy for companies to borrow and then deploy and grow, or even consumers to borrow and deploy in Costco, right, or wherever it is you spend your money. Then that's the theory, and it typically works. It's been proven to work over the last 50 years or more, and we're currently in this nasty one of the worst inverted yield curve scenarios that we've seen in the last 20 years. So this is not going to play out bullish. This is going to play out to the downside for equities and the economy as a whole. It's just very, very slow, and we don't want to feel it and admit it. And so when we're trading and investing in stocks, we've got to be paying attention to some of the longer term perspectives, but then also what are we dealing with in the short term? Because ultimately equity prices are going to do what they do because it's a marketplace. Everybody's buying and selling in real time based on what they think the future is going to hold. So there's a lot of value in that perspective as well, as having what is the current market telling me. And I actually trust that more than I do any type of indicator. I trust price activity. What's the market doing? Are we seeing uptrends, downtrends? And so in terms of watching what we're watching, we've got to be aware of that. And that may be the early indications of some of this starting to unfold, and we may be starting to see a little bit more risk come back in to the market. We're sitting right at these upper highs. If I pull this back in again and maybe go out a couple years and change this over here just so we can see some of these lines. But S&P 500, we're right at this resistance area, and there's another resistance area here. So we could, within this overall stair-stepping process, you've got these layers right here where the market's breaking through each of those layers. It's going up, it's breaking through, it's pulling to here. It's breaking up, it's pulling through, but now back to here. So we're still in that overall uptrend as defined by a stair-step process, or these support resistance locations, and that has yet to fail. When we start to fail those areas where the market has been before, then that is another indication that the trend is shifting. So these are very interesting areas as we stand right now, because there's a possibility for another breakdown of support, and that's only going to this is only bolstering the current idea that the market is stagnating. It's not rallying aggressively. There's some confusion in the market or some complacency where nobody's really making any bets at this point. And that makes sense, though, after an uptrend and a counter trend pullback, to be watching this price activity at this point, at this bounce, because we could very easily bounce off this level and then head back up, retest these levels, and then possibly even go back up and retest highs. We're going to need some additional catalyst. Okay, we're going to need some idea. The market is always looking forward. The market's looking out here on catalyst. And so if there's no catalyst to say, oh, wow, earnings were amazing and things are looking fantastic, or CPI numbers this, or blah, 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 whatever the pardon me, whatever that catalyst is what's going to ultimately move investors to one direction or the other. So let's take a look at, one other thing I wanted to point out here on this sector's scan is, as you're looking through and looking for different ideas, don't forget that you can come through and say, all right, I want to look at, let's say, finance stocks. And that finance stocks, I want to drop down here and say, let's take a look at, banks or regional banks, or whatever the case may be. What's interesting here, I was looking at this REIT mortgage indicator, or this REIT mortgage sector, I should say, and equity residential. You're just seeing just really ugly buy-sell ratios. All of these are in downtrends. Why are we starting to see financials starting to move to the downside? And are we seeing banks starting to move to the downside as well? You can see these major regional banks sitting in hold. There's nothing in buy 3. So is that starting to shift over as well? Consumer loans, 0, 9, 15 sells. Okay, so something's happening here in this financial sector where we're starting to see really significant move to this sell side. Is this Fitch thing going to continue this acceleration of these banks, and is that ultimately going to create some kind of contagion in the marketplace with banks? That's that's the doomsdayer. I don't like to do that, but we're just focusing on what's in front of us, the data that's there, and we'll continue to keep an eye on that. So new buys. Let's take a look at some of these. We've got a couple of biotechs that are interesting right here. If we pull this back. So one of the things you can toggle that, get rid if you don't like the signal. Okay, that's going to show up here as well. Just gives you some context. If you don't like that, you can always just toggle it off and look at that different perspective, traditional type view of a candlestick chart. We're seeing a decent move here on PLSE. I'm going to actually just move that back, and then let's take a look at the next couple that we've got. PLSE. This has been a really high flying stock. This trend was really smooth and nice. Started to break down, consolidate. Big move higher, retracement, and did we end up getting a retracement back into that 50% zone? Yeah, pretty close. It started to bounce a little bit deeper than that, and so keep an eye on PLSE for today. MANU also leisure recreation moving higher, and had a pretty decent retracement. We'll see if we get any acceleration. Again, these market conditions are not super conducive for rallies. We may see, some of these stocks, we'll keep an eye on them because it's definitely going to be a stock picking market right here throughout the remaining months of fall, and as we start to see what the overall market conditions are going to continue to look like. INTR and ALSN top out the top 5 auto trucks. That transportation sector is still continuing to do well. Those auto parts and truck part companies have done quite well this year. We'll see if we get any continuation on that overall update or that overall price pattern. That'll do it for today's update. Everyone have a fantastic day today.